Hi, ladies and gentlemen, 7th episode of Bar the Dip. I'm very happy to have with me today David Belle. It's good to see you, David. Pepperstone Talks recently had you on at the panel discussion. Dave, as we like to begin Bar the Dip, we like to introduce our guest. So tell us a bit about yourself and how you got into the world of finance and a bit on your background.
I'm David, as you've already introduced. I got into finance really from about the age of 18. Started demo trading as everyone does. Went and did an economics degree. After that, went and did a very short course at the University of Essex. I was trading all throughout university, successfully and unsuccessfully. Was at the perils of 2015 when the S&B decided to remove the peg. So that's quite a nice anecdote. But yeah, went into the course, met up with who was then the president, I think, of FX Street, maybe chief editor, who's now a good friend of mine, Gus. And he kind of brought me into the world of finance, really. That's how I started to meet people. And from there, it's just been a bit of a whirlwind working at brokers, trading, personal account, working at TradingView now, for example, and also setting up Macrodesiac, which is, a research service for retail traders. But from a slightly nicer perspective than most of the other boring stuff out there. We like to throw a few swear words in, a few jokes, a few memes, rather than have the drab and dreariness of
the stuffiness. Yeah. No, you
exactly.
definitely do add some unique flavor and color to your research, David. I'm a big fan of it and I read it regularly. Dave, next question. Thanks for the intro. That's very interesting. Next question is, knowing what you know now, what is the one thing you wished you could tell mini David Belle when you're starting out, if you could tap him on the shoulder and give him some trading advice?
Trade small and stay in the game. That's absolutely the number one thing I think, is that for 95% of the time, you want to be trading pretty small in my view. And then for that 5% of the time when you kind of get, it's like this feeling, you're South African, so you've probably played cricket once or twice, haven't you? Or have you not?
No. I've played cricket. Yeah, I used to play at high school.
So when you're batting, right, sometimes, and it doesn't happen very often, but sometimes you see that fast cricket ball coming at you like a beach ball, and you're just like, you're hitting everything. Do you know what I mean? You're hitting it right in the sweet spot and you're doing it right. That's the time, if you want to use the trading analogy, to size up a little bit. You just know that it's going to come off. And it's good to document that feeling whenever you get it, because then you can understand what market conditions are giving you that feeling. And how you're feeling yourself, I guess. And how the market's acting, what events are going on, what does volatility look like, is it elevated, is it subdued, all of these different things you can start to factor in, and then you prioritize which one is really, really causing you to just really know that the market's moving in your direction. This does tend to come after a smaller entry, so it's not like, oh yeah, you're gonna lift an offer and it's just gonna work off of your initial entry. It's really when you've already been made feel a little bit more comfortable and you're looking to size up. But yeah, 95% of the time, keep it nice and small and tight, and then just go for those bigger home runs when we get the feeling, which comes after experience, I guess, as well.
Yeah, time in the market. Dave, the next question is sort of similar to the previous one, and it's, what are some of the biggest tips that you could give to new traders, as well as major pitfalls to avoid? Have you got any other additional things that you think retail traders, when they're first starting out, or newbies, really need to avoid, like landmines?
I'm very biased on this side naturally, but I think most of the retail education, if you want to put it that way, is focused towards technical analysis. Now, technical analysis is fine, but I think a lot of people get drawn into the belief that, technical analysis tells all in the market, that you don't need to understand all of these other things. It's one of those concepts where you really, really have to mix up, a couple of different disciplines. So, I'm heavily biased to the macro side. But if I see a strong technical level, it's probably going to indicate to me that, there's some sort of interest around there. Should I look for some kind of event to push it one way or the other, or that kind of thing, Whereas a lot of people, I think they try and build a system purely around technical analysis. And, let's face it, if a lot of technical analysis systems did actually work, they'd be arbed away pretty quickly. You at home as a retail trader are not smarter than teams that have PhDs
Prop
and things like
desks
this.
at hedge funds, yeah.
Do you know what I mean?
They're fast.
I think as well, I probably shouldn't say this since you guys are brokers, but retail traders' timeframes are way too small. You see people looking at the 5-minute chart, the 1-minute chart, saying, "Oh yeah, I'm a scalper." Your costs are so high as a scalper that it probably doesn't make sense to do it once you've factored in all of your transaction costs and whatnot. It's just too much effort for the reward and the stress as well.
Yeah, I guess it's like a really good golfer. You can't just drive the ball well. You can't chip the ball well in isolation. You can't just be a good putter. It's sort of like a holistic approach. And, when you were mentioning about the peg breaking, the Swiss National Bank removing that peg, you could have a really good technical support level, but they do that and it'll slice through that thing like butter, So I do agree with you. I like to bring a couple of different disciplines into my analysis style: fundamentals, technicals, and quantitative side, positioning, that sort of stuff. So I definitely am in agreement with you there. I don't think you should just stick to one. You should try and use all analysis disciplines. Dave, onto your favorite part now, the macro big questions. You've got out the way the boring stuff. Can the ECB have their cake and eat it, i.e. raise rates to contain inflation while containing peripheral spreads and a sovereign debt crisis? If so, how do you think this affects the euro?
In short, no, I don't think they can. And they've been talking about this anti-fragmentation tool to contain those peripheral spreads. Peripheral spreads, the difference between, and the example always used is difference between the 10-year Bund and the Italian BTP, right? Italian specifically because it was the largest country, I guess, in the last sovereign debt crisis to fall foul of it. Now, they've been talking about this tool, but no one actually knows how it would work. They've been mentioning things like selling, Bundesbank, selling German bonds via the Bundesbank, which will create losses at the Bundesbank and, all other national central banks and things like this. So it seems to me like they're talking about something purely to try and set a narrative. But really what the market will do, like they're doing with the BOJ, they're testing the 0.25% level on the 10-year JGB, is they will test the ECB's resolve to see if they actually do introduce a tool. And until they figure out how to do it, it's come up against loads of legal problems so far, especially in Germany. Like someone brought a legal challenge to the German High Court, I think it was last year or the year before, over QE. So, until they actually have a tool that can work, and we know the details of it, I think there's still that massive risk of those spread blowouts, to be quite frank with you. In terms of the euro, I actually would look away from monetary policy there, and I would look at one of the big risks for the euro being the fact that they've kind of got the EU has got themselves into a bit of a bad state here, since they have suspended the fiscal rules. So the 3%, I think it's about 3% deficit spend limit, maybe 2%.
No, it's 3, yeah.
And they've suspended that until March 2023. Now, the problem is if they reintroduce that, that's going to create austerity. But on the other hand, if they kind of get rid of that, it removes one more thing that the EU has to keep kind of a union, I guess. It's just one more rule that relaxes their control. So creates more uncertainty from that perspective, which I think is a euro negative at the end of the day. On the flip side of that, if we're looking at the euro dollar trade, I think that at the moment the dollar market is very, very tight. in terms of dollar liquidity. If you look at LIBOR, 3-month LIBOR, for example, it's up at maybe 2.5%. It's just literally gone chaotic since the start of the year. So that's showing some tightness in dollar funding markets. If you look at HIBOR as well, which is the Hong Kong dollar, you can see that too, basically. And that's why the HKMA had to do some monetary interventions, I think just last week or the week before. 12 months out, that spiked up massively, and is coming to closer to nearer tenors as well now, where we're seeing spikes up in Hong Kong dollar funding. So we're seeing these issues now, which are, of course, a consequence of, tighter global monetary policy. And that is, one of the real issues with hiking. It's not just, interest rates go up. It is more of a factor of, okay, now what happens to interbank liquidity and interbank borrowing?
Yeah, I mean,
especially
they start selling German bonds and buying, Italian BTBs. You got the northern countries in Europe start kicking off. They're not too happy about that because it's kind of like a transfer, and the legal challenges come in, and obviously the restrictions, the conditionalities of the OMT, the previous program, which actually never got used because Draghi jawboned it so well. That's going to be too. They won't accept that. The conditionalities of that program was too hard. So maybe they have to find like a sort of Goldilocks in between, completely loose and no conditionality and something. Look, I don't know. I think personally, maybe they might be able to pull it off if they can get this sort of bespoke tool. They can sterilize with. We had the sources out yesterday talking about this deposit scheme to soak up that excess liquidity. And I mean, yet to be seen what the conditions are, but they could disappoint the market if they put a size number on it, because maybe they want it to be unlimited, the purchase power of this program. So obviously Euro doesn't like the BTB bund spread widening. It's always been a negative, and as you mentioned earlier, the other factors on the fiscal front. So that'll be an interesting one playing out. Let's move not too far away from the euro. Let's move to the Swiss National Bank. They obviously surprised markets with that 50 basis point hike, and the Swissy strengthened rapidly as a result. Are you bullish on the Swiss franc as a result? And we've just seen actually Euro CHF has broken parity. What's your thoughts, Dave?
Well, I think if you look at the recent history, I say recent, maybe the last 10 years history of the Swiss franc, no matter what the Swiss National Bank have done, the franc's just got stronger. If you look at it as a general trend, they introduced their unconventional monetary policy where they're buying foreign assets, specifically US equities, offering the franc. It's just not worked. So there's something that I mentioned at Pepperstone Talks as well, which I think I think the question was the most interesting central bank kind of context. And I thought it was the Swiss National Bank, because it'd be interesting to see how this, short-term regime change in terms of inflation, et cetera, changes their view. And of course, Jordan, he was happy to raise by 50 basis points, which was massive. It's a massive, massive pivot, and I think, based off of that, we're going to see the ECB do the same. There was even chat today of moving 50. I would say that the Swiss National Bank is probably the smartest central bank out there, and it has something to do with their status as a neutral country too. And obviously, massive pioneers in finance, banking history going on for a couple of centuries now. So I think, they're definitely one of the interesting central banks to watch, and it should be, I think it might be at the end of July. It'll be interesting to see the Swiss National Bank's NASDAQ filing, their 13F, because then we can see, what they were doing over this quarter. And it can be a good gauge for, depending on how much they've sold, because I think they've sold a lot. I was about to swear them.
Macrodesiac, it's by the dip. We can't swear on this show.
Yeah, exactly. So I think they've sold a lot, probably sold a lot of Apple, and potentially there's more to come.
Hopefully they didn't have too much Netflix, huh?
Well, yeah, I think they do actually hold quite a bit of it, to be honest.
But now, how does that
I do,
affect the Swiss franc now if they're offloading that? Because obviously they're going to buy back Swiss francs with those liquidations that they've done in their Nazi.
Well, it actually depends on what they do with it, because they may in fact shift it to US Treasuries, which might create a bit of a reason to be long bonds. And the reason I say that as well is because the Fed has opened up this recent FEMA facility. They've made it a standing facility for dollar liquidity, and it means that central banks can swap their treasuries as a repo for dollars, whereas before they had to, do an FX swap, which basically opens up the market to even the PBOC now. Before the PBOC weren't actually accessing dollar swap lines, whereas this time, if the dollar sort of liquidity issues do get too much, central banks like the PBOC, because they hold so many treasuries, can access those that FEMA facility. But I think they won't actually repatriate it into francs. I think they'll actually buy US Treasuries. It makes more sense to do that.
Okay, all right.
So basically, no difference up to the franc. and
you bullish on the franc over the shorter medium term? Would you say it's one of the currencies?
Yeah, you have to be.
Because you want to align yourself with a currency where the central bank's actually looking to potentially utilize currency strength as a tool to tamper down inflation. At least that's my take on it.
I totally agree. And also there's the traditional sort of psychological belief of the franc being a safe haven, especially with how the yen's behaving too at the moment. No one really wants to touch the yen. So where would you go? You'll go to the currency which has, a long-term trend of strength, basically, especially at times like this. If European data deteriorates more, then I think, franc, the euro versus the franc is going to go way lower.
What do you think the SNB's pain threshold would be? How far below parity do you think they might go? Hang on a second here, this is a bit too much.
I can't say too much about that, can I? Can't say targets. Retail effects regulation.
Oh, sorry,
but
Dave.
Lower.
I'd
say lower.
Okay. All right. Yeah. How much lower? No, I'm just kidding. I'm not going to
go there.
All right, next question. So if you were the Bank of England governor, how would you deal with the current stagflation conundrum sort of permeating through the UK economy? And what do you think this means for the pound? Hopefully you wouldn't be telling people not to ask for a pay rise.
I was literally just going to mention that, just don't ask for wages to go up. No, honestly, they've got a really, really difficult job, I think. But coming out with statements like he did just is so stupid. I guess, what can you do? Raise rates quicker. That's all you can do.
So that's interesting you say that, Dave, because I'm sort of the opinion that raise rates, but you can't drill an oil well in Threadneedle Street, and you can't invent people to join the workforce. Now, these are issues that their tools can't really help with. And everybody keeps saying demand's too strong, it's excess demand. I just think it's too little, insufficient supply. Now, if you ask the average person on the street, would you rather pay slightly higher prices? So I'm saying get inflation back to 3.5%, 4%. Don't go obsessively for 2%, which I think is outdated because we've been through a pandemic and a war. Rather, don't cause serious economic pain and a hard landing, as the new buzzword is, and unemployment, and just get inflation down to a relatively lower level. As I said, 3.5%, 4%. But I don't think they need to slam on the brakes and cause serious economic pain. That's at least my opinion of it, because their tools aren't perfect for the inflationary forces that are coming through. But I'd love to hear your take on that.
So this is going to be very anecdotal, but I watched a video this morning on Twitter of a TikTok, which is quite funny. And it was of a girl, and she was going through her day at work, right? And the video started off with she went and got her favorite coffee. Then she went to a lounge area at work. Then she wrote an email. Then she went and watched some ping pong. Then she went and got another chai latte or something like this. Then she went to the relax room and wrote something else. So I'm thinking, how many of these jobs are out there where there's so much slack, they're being paid, pretty decent entry salaries. How much slack is out there because of the cheap money, if you want to put it that way, or the lower risk premium that has been pumped into economies over the last, decade, let's say, because that's what it's coming to. It's coming to the end of a cycle, I think. And one of the things, I think it was Morgan Stanley that wrote back in March, was to get inflation under control, the Fed's going to have to get to 10% unemployment, which I can kind of see as something that is necessary, because I think there's so much misallocation of capital that's happened that we've got these startups. If you look at, I think it's called layoffs.app. If you look at that site and you see some of the startups there that are laying off now 20-30% people, it's like, you must have only been surviving because of these cheap rates. You're loaded to the eyeballs with debt. You've got these people on high salaries. You're not actually making a decent product. You're not making even any revenue. So how much slack is there out in the economy for these things to be going on? Because at the end of the day, all of these crappy jobs, they do amount to something broader when you take them on aggregate. They amount to less productivity. You're getting a wage for doing nothing. What you add into the economy, rather than just, do you see what I mean? Okay, you can go take that wage and spend it, but most people are going to be putting it into housing, which is a unproductive asset, basically. It's a necessity, but it's an unproductive asset. You're not benefiting anyone by just doing it. So I personally think that there has to be a clear out of this misallocation of capital, and that kind of job where she was able to just document her whole day, have 4 or 5 chai lattes, watch someone playing ping pong. There's no productivity gains there. So higher rates, I think, necessitate higher productivity, because these firms aren't being funded to be able to have this low productivity drain, basically.
Okay, and there we go. Good answer there. Going back to economics 101. Moving on from TikTok videos and chai lattes, what's your outlook on the pound then? Are you bearish?
Oh, so I put out to Macrodesiacs the other day that I think one factor to change the trend in the dollar will be that FEMA facility that I spoke about when we were talking about the Swiss National Bank just a minute ago, being used. Because every single time that a dollar swap line has been used or started to be tapped up, the dollar's fallen. So I think, looking at 3-month US dollar LIBOR, it's gone bananas, and it's near kind of the top of the range at where, if you were to draw a trend line, I know you probably shouldn't draw a trend line on LIBOR, but it's what it is. It's fallen again. So it's about 2.5% now, I think. Like, don't quote me there, but I think it's at 2.5%, which, yeah, as I said, shows stresses. So what I think we need to have happen is the dollar just needs to stop this bull run. And I'm a dollar bull all the time. Like, I don't see any real upside to being bearish the dollar, because if you look at it over most of the time, what you're seeing is the dollar go up, basically, relative to other currencies. But yeah, I think for the pound to reverse course, it's more a dollar story than anything. Pound's very risk sensitive as well. So, dollar comes back down, probably feels like there's some risk appetite coming back into the market. I personally don't see it happening for a little while, though. I think, yeah, for me, the trigger for a regime change is that is that FEMA facility being used. And I like to get quite niche with these things so that I've got a nice anchor in my head. So I will then just focus on that. I don't care about missing other things. If that one thing happens, then that's enough for me to action something.
It goes back to your beach ball analogy earlier when you're playing cricket, eh?
Yeah.
Dave, we've seen Japanese government bond swaps priced quite a bit above the yield curve control upper bound of 0.25%, given the BOGA only intervene in the cash market. Clearly, the market is taking a bet that the BOGA is going to remove this cap, or at least some are in the market, some big fund managers. What are your thoughts on this and the implications for the yen?
Do you know what? I don't really have any more thoughts on it, because I don't really understand what the BOGA is playing at. I think the market absolutely is testing it, but it's not, it's one of those things where you just say, okay, I just don't understand what's going on now. You know, the yen is getting absolutely smashed still. I actually thought it would start to top out at about, you know, 130, 133.
Where are we now? Actually,
That
let me pull up my chart.
I think
On
it
trading
at
view,
the
my
talk,
trading view chart.
I think at the talk as well, I
Yeah, we're
mentioned
around
130.
136.4 at the moment, so we're almost back
Well,
at
there we
those
go.
136.7 highs.
Yeah, we're another 100 ticks up from, you know, that 20-year high. So
Do you think
I
they
genuinely,
fold? Do you think the Bank of Japan at some point just goes, we need to actually just, why? I don't know, maybe they take a two-prong approach. The Ministry of Finance buys a bit of, sells a bit of foreign currency, and then the Bank of Japan doesn't necessarily completely remove the yield curve control target of 0%, but they just widen the bands, the lower bound and upper bound maybe to fluctuate by 50 basis points, 0.5% and negative 0.5%.
I mean, that would make the most sense, wouldn't it? But they've not made much sense until now. So who knows if they'll make any sense in the future?
I think
See what I
Kuroda's
mean?
desperate, though, to try and get the Japanese economy out of this 15 years of deflationary spirals, you know. So maybe
Yeah,
that's why he doesn't want to. And you look at the debt to GDP of Japan, it's not
but
very pretty.
but the thing is that okay. So this is one other reason as to why I think they need to stop focusing on inflation and they need to target nominal GDP because okay, you want to get out of this deflationary spiral, but what does that mean for growth? Just because you've got higher inflation doesn't mean you're getting growth.
Mm.
You see what I mean? It just means the prices are higher. You need that real growth to be up and trending up for it to make sense as a policy. Well, not trending up, but remaining consistent at least. You know, it doesn't make sense to just target inflation for the sake of targeting inflation, because obviously things go in cycles. Like you could have, to an extent, positive growth and deflation. I guess it's possible. It's not likely. So, you know, when do they start to say, okay, well, you know, we kind of need to change what we're looking at a little bit, because price stability at the end of the day is not the be all and end all. Like if you had growth trending at 5% and inflation at 4%, is that a net benefit or is it bad? You know, I would say that it's quite good. But then they'd bring in this arbitrary 2% measure, which would probably impact growth. Do you see what I mean? So it doesn't make sense to me from that angle, really. And I think they really need to focus now on targeting NGDP, which to an extent the Bank of England actually were doing, because they had a 2% plus or minus 1% policy, or they do have that policy. Maybe even you could consider AIT to be that, average inflation targeting. So I think there has been and there is a shift, you know, in the Fed going on towards doing that. And I think it's what needs to happen.
And the yen, do you think it's going to continue to, think we see 140 potentially? Do you think that is actually a realistic price move? We almost just under 4 big figs away from there now, basically.
I mean, yeah. I mean, we just keep blowing through, you know, tops that are made, short-term tops. I don't see why not.
But a lot of people are starting to say we've seen the peak in US rates potentially now. And obviously, if that is the case and that goes down, that yield differential will narrow and actually be quite bullish dollar yen. Sorry,
Yeah,
would be quite bearish dollar yen.
But they've been saying they've seen a peak in yields for the last 2 years. I was saying it. You know, I was saying it down at 2.25%. I was completely wrong. You know, it could be that we're in a really, really big, not necessarily regime change in terms of the longer term picture, but maybe the shorter term, that's what happens, is that we see elevated yields and we do go higher, and it breaks the trend of the last 40 odd years, you know. It's been a big shock and a big change in terms of what's happened with the pandemic and the economic reaction. You know, we've never seen, I mean, since the war, the World War II, we've never seen governments just basically hand money out to people outside of obviously the welfare system and that kind of thing. So, you know, behaviors were changed. It was almost like a bottleneck of money that was just put into things that were very much online, very much, you know, in a lot of cases, not really tangible for the longer term future, apart from the housing market. And so, you know, I think it's once you concentrate money flowing into certain things, you do create these massive dislocations. So that's probably reflected in the bond market as well still.
Dave, we've got 2 questions left because time is beginning to run fairly short.
Have I been talking that much?
Yeah, blabbermouth over there. Right, Bitcoin broke the 20K level. What are your thoughts on the future of the space with confidence taking a really serious pummeling?
It's just one of those things, isn't it? It's, you know, I think Bitcoin is the most sensitive asset to interest rates. If you throw euro dollars contract EDZ 2022 over a Bitcoin chart and look at the correlation, it's literally replicating it. You know, it's a short-term interest rate proxy, and it's a cheaper way to access euro dollars than actually trading euro dollars itself. So, you know, if rates start coming down, Bitcoin's going to go back up. That's the way it happens. You know, that's the only way I think of it. It's purely a short volatility trade if you're long Bitcoin. And again, it's probably cheaper than, you know, just staying short the VIX.
And do you think, though, that this has maybe made a lot of participants exit the crypto market because of what we've seen with the breaking of stable coins and you know, just it's just had a really bad sell-off, and I think a lot of people have got their fingers burned. Besides very interesting insights you just shared now about the correlation and a proxy for rates, you know, longer term, do you think Bitcoin will be around and that sort of stuff?
Yeah, of course. Look, I think many people just consider it another trade. Like most of the guys that, you know, I'm part of crypto Twitter to an extent. Most of the guys literally just see it as a trade and a way to make money. They're not evangelical about it. You know, if it goes down, they'll trade it. If it goes up, they'll trade it. You know, they hold a spot bag and they'll trade leverage, you know, as you would with FX, for example. I think many are coming around to the fact that there are more macro factors involved with it, which they hadn't done before, let's say, 2021. I think there's much, I can't even talk now. There's many more people that are respecting sort of how the Fed, how central banks, how rates, you know, impact cryptocurrency than there were before. At the end of the day, it's the highest beta asset of highest beta assets. You know, you've got the crap coins, you've got the kind of mid-cap coins, then you've got Bitcoin in terms of if you want to have beta right at the top of the pyramid. Like, it's higher beta than micro-cap stocks. So of course, it's going to be very, very rate sensitive, and liquidity is going to dry up as global liquidity dries up. You know, it's just the way of the market. But I think, you know, in terms of people being scared off, people are only really scared off once they've been liquidated. It's not necessarily the market doing it. Like if they were sellers of the market, then they wouldn't be scared off. It's just that they've got no more money to buy in at the moment. So they're probably waiting for lower prices, and then, you know, the whole trend will start again, and the trend will kick off again with rates being cut. It's just the way it works. It's happened the whole way through for the last 13 years or however long Bitcoin's worked for. Just now it's even more sensitive because the market cap's bigger. You've got bigger players who are sensitive to the macro conditions more, you know. Again, it's just another trade.
Right, Dave, thanks for those insights. Crypto Twitter, love it. Right, last question. Tell us about your analytical process. How do you evaluate investment trade opportunities if you had to distill it down to sort of 3 major factors? And then once you've done that, just briefly, very briefly discuss a macro trade idea that you like currently.
Okay, so I think this was told to me by the head of an FX desk at can I say the name? Market Securities. Yeah. So they are a big broker, and he basically said, try and see what others aren't seeing or talking about. Like, try and make that your focal point. So, for example, with the FEMA thing, you know, most people aren't probably focused on that as a condition for a change in the dollar direction. And so the way that I think of things is, could this potentially very, very small, unlooked at aspect of the market lead to a trade which has all of that upside, versus if it doesn't work or you don't get a reaction from that thing, you've got such small downside. You see what I mean? People say don't try and pick bottoms and tops. Sometimes I think that's a load of nonsense. Because I think sometimes, you know, you really want to maximize some of those trades where they make up 80% of your P&L for the year, or maybe 60 to 80%. They come around, you know, maybe 3-4 times a year, and they're the ones that really maximize your gains at the end of the day. So I really focus on that as an initial kind of base. I look at what the dollar's doing heavily as well, because, you know, from taking in certain data points, like if growth's good and the dollar's up, what does that mean? If growth's bad and the dollar's up, what does that mean? You know, and then seeing, okay, there's this disparity between growth and the dollar, or inflation and the dollar, or whatever metrics I'm looking at. What do we need for that disparity to change, and will that cause a trend change? Do you see what I mean? And so I look at factors like that and try and really focus it from a top-down perspective. But, you know, at the end of the day, in an environment like this, all that matters and all that has mattered is interest rates when it comes down to equities. You know, if interest rates are going higher and inflation's needed to be fought, for example, like it is now, then they're going to be very aggressive with rate hikes, which is going to drive it's going to drive risk premiums up, which causes equities to fall, because it's basically more expensive to hold equities than it is, you know, a risk-free rate of return. So in terms of the longer term trend, that's all I'm waiting for, is them to signify that they want to cut, and I'll be long equities again.
Okay, and what is that? Is that your macro trade that you liked at the moment, Dave?
Yeah, it's that simple, pretty much. Okay. Nothing more about it, to be honest.
Okay. All right, Dave. Yes, sorry,
yeah,
Dave.
No, let me expand on just the last bit to like show exactly what I'm waiting for. So just wait until the market starts telling you, in terms of, you know, if you're looking at short-term interest rate futures, if you're looking at different spreads, etc., start, you know, factoring that in, because I think the March-June 2023 spread on euro dollars started showing a bit of a cut. Now, I don't know what it looks like right now, but these are the things that I'm looking at. Like, if that comes nearer dated, then that might actually be when I start buying in. It hasn't yet, though. You know, we're just going down at the moment.
I mean, it has come in so far, but to March, it was obviously further out. Like, what? Yeah. You know, what are we talking? Coming in maybe to December 22? Would that be quite a strong signal for you?
Yeah, for sure. December and earlier. You know, if we're looking at over the next couple of months, if there's like a credit event that happens over the next couple of months, I'll bring that right forward. Like, I'd bring that to like September, because if you look at 2008, end of 2008, 2009, equities bottomed out in March 2009, didn't they? But all of the QE was introduced, I think, in late 2008. I could be totally wrong on that timeline, but I remember that they bottomed out in 2009. And so there is a kind of feed-through effect where, okay, they might announce this, but it might take a longer time for it to actually feed through and equities to start moving, or risk to start moving again. So it wouldn't be, you know, something instant I'd act on. I would wait maybe a month or so.
Okay, and just for the FX traders out there that like to play in FX land, is there any particular FX pairs that you like right now at the moment?
Yeah, dollar rand.
Dollar rand.
Long dollar rand, yeah. Because yes. I just think, and you know, you're pretty close to this, obviously, like this. I can't remember what it's called. Is it called staging?
Load shedding.
Load shedding, that's the one. See, I don't even know the term, but I just remember that it's something's bad.
Yeah, it's
all of this load
bad.
shedding. Yeah, it's like there's no electricity. You know, the political situation's very kind of tumultuous as well in South Africa. If we're seeing global hiking, then, you know, South Africa as a commodities exporter, that's not going to be good for them if demand dampens. So there's a couple of different factors, and I bought dollar rand last night at about 1601-ish, I think 1605 maybe. And I think, yeah, it's one of those where the trend has been up for a long time, and there's been very strong corrections, but we've had a strong correction. So it feels to me like, you know, it could just tick higher again over the next year or so.
Yeah, I'm just looking at the chart now. We really saw a blow off yesterday when that stage 6 was announced.
Yeah.
Right off that 50-day simple moving average. Yeah, they call it the Rattler Rand because it's so volatile.
Yeah.
But it's also very
terrifying.
liquid. It's also one of the most liquid EMFX pairs. So it's definitely a good currency to trade. I think I made a comment to you on Twitter last night. Actually, I said I quite like Mexican peso ZAR, just because of that carry when you're having to obviously borrow in rands and short and go long the dollar. That carry that you have to pay.
Spread on that.
Pretty chunky.
Yeah, I was gonna say.
But yeah, I reckon dollar rand, I don't think you can go wrong right now. There are a lot of factors working against it. But Dave, I've taken up enough of your very precious time. And
time.
Your tweeting time on Love Island. Dave, thanks so much for joining the 7th episode of Buy the Dip. And I'm sure everyone that's watched will really find it valuable.
Cheers, mate. Thank you for having me.